So, Bill, let's do the clinic. How the purchases of T-bills affect both liquidity and short-term rates, and we'll separate the two. Rates first. Walk us through it.
A little bit of downward pressure on short-term rates just because reserves are more abundant in the system, so that pushes down the federal funds rate slightly. But the effect on the federal funds rate is probably about, in the order of maybe 3 basis points, 0.03 of 1%. So the idea that that's causing the big 10% rise in the stock market is just not a credible story.
Then we turn from rates to liquidity. The phrase liquidity, the term, I think is one of the most overused phrases, terms in the whole of financial media, financial markets, and probably the least understood. When people say we're flush with liquidity because the Fed is doing this and it's boosting risk assets, what do they mean by that and what are they getting wrong?
Well, they have this idea that when the Fed buys T-bills, they're adding reserves to the banking system, and somehow those reserves are leaking out and leading to greater demand for the stock market. But the reality is the reserves don't leak out of the banking system because if someone withdraws their money from a bank, they make a purchase, that money flows right back into the banking system. Banks can't affect how many reserves there are in the banking system. The Fed determines that. Those reserves are not used for other stuff like buying bonds or buying equities. The reason why the stock market is going up is pretty simple. The economy is doing well, earnings are rising, and the Fed has basically said that they're on hold for quite a while. They want inflation to rise above 2% before they even begin to contemplate tightening monetary policy again. And that's a big change from where we were a year ago.
The shift in the reaction function has been massive, but it hasn't stopped people from talking about whether this is or isn't QE. The distinction between the previous rounds of quantitative easing and what we have right now, is it duration? Is that the key distinction?
Absolutely. I mean, all that's happening is the Fed is basically creating overnight liabilities on its balance sheet, bank reserves, and then using those liabilities to buy very short-dated Treasury bills. Now, if you thought that the Fed's purchase of Treasury bills was leading to a collapse in short-term interest rates, then you could make the argument that that was somehow boosting the bond market and boosting the stock market. But the change in short-term yields is trivial. I think what people misunderstand is QE, when it was done back in 2009 through 13, was about buying long-duration assets, pushing down long-term yields. When long-term yields fell, that made equities more attractive. The purpose of these asset purchases is totally different. The Fed's not trying to affect the level of yields. They're just trying to add reserves to the banking system so banks have enough reserves so there isn't the risk of a spike in repo rates like we saw in September.
Exchanging one risk-free asset reserves for another,
exactly.
T-bills. Here's the problem. If enough people believe it, isn't it a problem for the FOMC? Get back to the Federal Reserve. You're seeing all of this play out. Would this be a problem for you?
Well, I think what the Fed will be thinking about is, okay, this is making financial conditions more accommodative. That means that's providing support for economic growth. That's not a problem, though, because they basically said, we're fine with economic growth as long as it doesn't lead to too much inflation. So they basically said that we're going to be patient until inflation rises above 2%. So if growth turns out to be 2.5% rather than 2% or 1.5% because the stock market is stronger and financial conditions are easier, I don't think that's going to provoke the Fed to move much earlier. It all depends on what happens to inflation.
Well, I'm just wondering if it will shape what they do with the balance sheet. So we're sitting here and saying it's not QE.
Because the balance sheet issue is about making sure there's enough reserves in the banking system.
Totally agree. But as you will acknowledge, there are a lot of people in this market right now who believe that the balance sheet operation is connected to risk assets. And I just wonder if the Fed will be sensitive to the idea that if they tee up rolling that bag, phasing that operation
that's
out.
That's one reason why I wrote the piece, because they are going to probably end the $60 billion a month Treasury bill purchases after the April tax season. They basically told us that. And so if you really think that that's what's causing the stock market to go up, if they stop, then people are going to be all nervous about it. But that's not really, in my mind, the reason why the stock market is going up.
So how can they navigate the communication problem? Because clearly they're going to have
one. I think they need to explain very clearly, why are we doing this? To add more reserves to the banking system, and what are the consequences of that? And push back a little bit against this narrative that their T-bill purchases are fueling a big bubble in the equity market. I just don't think that's true.
Final question for you, Bill, and I think it's going to be one of the questions that lingers through the next several years for central bankers worldwide. Balancing your ability to stimulate markets with your ability to stimulate the economy, and whether you do too much of one over the other, because trying to do the other is actually at the moment somewhat ineffective.
Well, at the end of the day, I mean, how does the Fed drive the economy? It drives the economy through financial conditions. So the stock market, the bond market, foreign exchange markets, short-term interest rates are all part of the thing that drives the economy to where the Fed wants it to go. So they certainly have to consider the financial asset prices in making their monetary policy decisions.